So when we have bulls and bears, the stock market can't be far behind, right?
Yes, that's precisely I was thinking as well. The name bull market actually is derived out of the way the bull attacks its opponent, uses its horns and throws the opponent right up in the air. Just like how the stock market moves the prices of all the stocks right up in the air.
That's right, actually, Feroze. In bull markets, we see investors who are very, very confident. We see the prices are heading up. There's a lot of demand. And, coincidentally, it's a time where we see a lot more IPOs and NFOs.
Yes, I think there is immense amount of activity in the market when there's bull runs, and also the fact that investors go through this huge, strong emotion of greed, especially in the phases of bull markets.
That's right. A bull market is a time when we see above normal returns, like we saw, for example, in the 2003 to 2007 period. So while the return for the Nifty on an annualized basis is about 14 to 15%, in this period, the index gave a 38% return per annum.
Now, that was one of the latest big bull markets. If you went back in time and saw the first recorded bull market, it started in May 1984 and lasted till April 1986, driven by the new Rajiv Gandhi era, where Sensex moved from 185 to 665. I think it's very important for market participants to understand these phases of bulls and bears so that they can behave more rationally, and history tells you what the rational behavior should be.
So whatever the year, there can be three major triggers for bull markets. One could be the macroeconomy, it could be corporate earnings, or it could be a gush of liquidity. Sometimes they all come together, or it could be one or the other, which actually triggers a bull market on its own. In either case, what we notice is that there are more buyers than there are sellers. But Feroze, everything that goes up must come down, right?
Yes, I think it's also about how long do these last. If you analyze the 6 major bull runs in the Indian market, they've lasted about 90 weeks, which is little over 1.5 years. And these factors which you mentioned, Sumaira, are very important for an investor, because to identify a bull run's beginning or an end, you will have to see what drives this engine.
But bull market is not always a linear stretch of expansion. There can be corrections in a bull market as well, right?
That is actually the inherent nature of the asset class equity. Bull market corrections are as frequent as a couple of times in a year during the bull market period. To identify them, we have to be very, very vigilant. A correction is defined as a 10% fall in the market from its peak levels. So this is definitely going to be an integral part of the bull market. But the attribute of these corrections in a bull market is the time frame to which they last. The shorter time frame is the evidence that it is not a bear market but a bull market correction. In the example of 2003 to 2007, we saw almost 10 instances where the markets corrected and made the investors believe that the bull market is over and the bear market is gripping in. But the bull market continued.
So bull or bear, consider them as phases of your investment cycle.
Like we were discussing the other day about bull markets and where the name comes from, this time bear market, the name comes from something very similar. The behavior of the bear, which puts its prey down, attacks it. Similarly, equity markets, when they fall, when they correct or are in a bear phase, puts all its investors down